Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy at NatWest, sitting in the U.S. And it was a very busy week here in the U.S. We didn't just get trade deals. We also had the FOMC. We had quarterly refunding. And we've had a number of developments in FX markets. Even though we're in quiet summer markets, we've had some pretty big moves in the dollar this week. And to break it all down, I'm happy to be joined by Ian Vanderhorn, who's a macro strategist with us here at NatWest, sitting in the U.S. with me. So, Ian, thanks very much for joining.
Yeah, thank you so much for having me, Brian. It's a pleasure to be here. You hit on all the highlights this week, but let's start with you. You mentioned that the dollar has strengthened a lot this week, and some of the reasons was definitely due to these trade deals that you mentioned as well. So why don't we start there? Can you tell us a little bit about those, walk us through some of the developments and what they mean for the dollar?
Sure. So trade has been, an ever evolving theme in FX markets. And with the latest being that we've had a number of deals clinched in the last few days. The big one, I think the one that got the most market focus was actually over the weekend, which was the deal with the EU. Now, it seems for major trading partners, we are sort of closing in on a 15% tariff level as the new standard baseline. And, for frequent listeners of this podcast, you'll know that was our expectation going into the August 1 deadline. Now, we're recording the day before that. And so by the time you listen to this, the trade situation could evolve again. But I think markets are sort of closing in on a base case of the worst case scenario once again sort of being avoided. And in this case, unlike in April 2nd, when you got delays in tariff implementation in a lot of cases, this time you're getting deals in in more cases. And so the existence of trade deals, whether it be with the EU, Japan, with South Korea, it perhaps introduces a bit more certainty about the future of policy, maybe reducing some of that overhang of uncertainty. And with that, I think governments, central banks, and investors can start to really plan around the permanence of these of these tariff impacts. And so I think it's right to say that the worst case scenario looks like it has been avoided. And I think one of the themes of this week has been markets pricing out some of that worst case scenario style risks to U.S. growth and to the U.S. dollar. So if you recall, back on April 2nd with Liberation Day, one of the perhaps surprising developments was markets were pricing in significant dollar weakness and higher rates in the U.S., particularly in the long end, because of these concerns that a significant overhaul of tariff policy would lead to a rapid shift in demand for dollar assets, and with it a big slowdown in growth. And so as the markets price away from that worst case scenario, we've actually seen the dollar rebound here, which is in some senses a bit surprising, simply because you would normally associate, a drop in uncertainty with a better performance for risk sensitive assets, including most of the non-dollar currencies. So maybe a bit interesting that we're seeing the dollar respond the way it is, but I think this relates to the shift in correlations that we've seen for the dollar, that in a lot of ways, the dollar trades as much like a growth currency as it does like a safe haven. These days, we've certainly seen those correlations changing between the dollar and relative rates and the dollar and equity markets. That's been one of the features of sort of the post-April 2nd, the post-Liberation Day landscape. And we should also acknowledge that the market has been short of dollars here. And as, maybe in summer markets when, liquidity is relatively less, maybe the path of least resistance is towards reducing popular positions. And one of those could include short dollars. And so, at a confluence of factors, I think one of the big ones is we've had these trade deals reducing uncertainty. That's a very big deal for foreign governments and foreign economies as well. Growth expectations, I think, broadly speaking, the risks to growth expectations globally should come down. That's a good news for non-dollar currencies as well. But the first order impact in the market, I think, has been to price away some of these worst case scenario tariff risks and maybe price out a bit of that dollar loss of exceptionalism style theme. And so we've seen the dollar bounce back. I think positioning a big part of that as well.
Yeah, absolutely. So you said positioning, you said pricing out of these worst case scenarios, it definitely feels absolutely right. We've also seen some pricing out of Fed expectations, particularly after yesterday's meeting. Why don't you touch on that real quick if you can? How did that change your calculus in the FX world and particularly the dollar?
Yeah, sure. And so, I think for the July meeting, it was widely expected that the Fed was going to leave policy unchanged and keep the core of their message the same. And that's what we got. But even so, I think the bigger question was not about what they would do, but it was more around the tone from the chair and the tone from the committee, the core of the committee. Because there were certainly some in the room who were advocating for a rate cut, not only in September, but a rate cut today. We know we got two dissents in favor of a rate cut today. And so we thought there was a possibility that Powell would have to acknowledge that there is a divide among the committee and that there are some on the Fed who are very open to cutting the policy rate as soon as September. Markets came into this pricing a better than even chance. They came into the Fed meeting on Wednesday, I should say, pricing a better than even chance that the Federal Reserve would cut the policy rate in September. Now, frequent listeners will know that's not our base case. We don't have the Fed cutting it all this year. That's been our base case for a while. But when we were thinking about the risk reward for the dollar, especially with it having rallied pretty meaningfully in the sessions leading up to the decision, I thought there might be some risk that if the Federal Reserve kind of keeps that door open for September, says, hey, we're not ruling it in, but we're not ruling it out either, maybe that could lead to some pullback. But instead, what we heard from the Fed, I think, was a pretty firm sticking to the core of the outlook, essentially, with Powell seeming to lean against, at least in his tone, the idea that September was a realistic timing to resume easing. He certainly leaned on the possibility of we're only at the beginning in terms of tariff-related impacts on inflation, and that the labor market is still in a good position. One thing that really, I think, was notable to me was Powell seemed to distinguish between the potential slowing in hiring versus a change in the unemployment rate. And there is some question among Fed members about how should they respond if, say, for example, non-farm payrolls, the gains in non-farm payrolls start to slow materially. Now, as you're listening on Friday, our listeners will have seen the non-farm payroll report coming out tomorrow. But there is this question about, hey, a slowdown in labor demand, a slowdown in hiring, should that motivate the Fed to more quickly pivot to growth? And Powell's view on this, I think, was pretty nuanced, where he focused on the unemployment rate and how a shift in labor demand lower, if offset by a drop in labor supply, say from a big slowdown in immigration, that could leave the labor market effectively in balance, even if labor demand, the pace of non-farm payroll growth, is slower. And so there were a number of more hawkish tidbits, I think, within this decision. Now, we still have a couple more non-farm payroll reports. We have a couple more inflation reports, and Powell did seem at least open to saying, we're going to get more data in the next couple of months, and we'll make a decision about September when September comes. But it certainly didn't feel like Powell was trying to set the market up for September. If anything, he seemed to be trying to warn the market that unless the data forced them to, then September is probably not going to be realistically in play. And so rather than lean against the dollar rebound that we've had, the Fed kind of leaned into it a bit.
Yeah, absolutely. I had the same read on that, which, interestingly, if I can jump over to the Bank of Canada real quick, if I may, they had the decision on the same day, often overshadowed, as is the case. But I sort of took the opposite read of the BOC decision. The Bank of Canada, they did hold their policy rate steady at 2.75%, as was widely expected. But they sort of opened the door a little bit to potentially ease again, in contrast to what the Fed was doing, what Powell did. They did say that they added a portion to their statement that said that they could potentially need to reduce the policy rate further if the pressure on inflation from tariffs and trade were contained. Now, in the context of the worst case trade scenario, as you said at your opening, potentially being behind us, this felt a little bit dovish, and it honestly felt like a bias towards easing in the future from the BOC. I also take this in the context of most Canadian businesses aren't currently feeling the effect of tariffs, as the Business Outlook survey a couple of weeks ago displayed. And the Bank of Canada yesterday said themselves that their expected, or their estimate for effective tariffs on U.S. goods or on Canadian goods coming into the U.S. was only 5%. So it really stood out as a contrast to me, the BOC versus Fed decision. And I think that if we get a soft Q2 growth number in Canada, as is the expectation, the Bank of Canada has a expected contraction of 1.5% in the second quarter, that it could really give them the green light to ease again, and they're sort of setting the stage to do that. I will also note that the guidance in terms of the monetary policy report, which is the forecast that the Bank of Canada releases with their decision, It again pointed to multiple scenarios when it comes to the tariff outlook. They presented a baseline scenario, so essentially the status quo of today, a de-escalation scenario, and an escalatory scenario. So they provided three outcomes. And if we think about those three scenarios, I think it's fair to say that going forward, we're probably going to end up closest to the baseline scenario. I would bias a little bit towards the de-escalatory scenario, even a little bit, despite what we've seen over the last couple of days. I know we've had some inflammatory language from Trump today and a little bit yesterday, but I think we're going to head in that direction. And in that direction of the baseline scenario, we see mostly stable core inflation, which has really been the Bank of Canada's problem in the last few meetings. Core inflation has been sticky. Employment rebounded. They really had their hands tied by those two things. But going forward, they expect core inflation mostly steady, growth to contract in the second quarter, and to rebound relatively slowly towards the second half of the year, just under this baseline scenario going forward. And I really think that gives them course to potentially ease again. The one other thing I'll note about the Bank of Canada, which again stood in contrast to the Fed and Chair Powell, who are really taking, a whites of their eyes approach, need to see the data, need to observe the data, is that Governor Macklem made a comment that they can act on policy for what they expect inflation and growth to be in the future. It was a little bit more forward-looking than he's led on to recently. And if we again go back to these scenarios in the monetary policy report, well, the forward-looking situation is very slow growth, albeit positive, and mostly stable core inflation. So I think they sort of gave themselves a little bit of wiggle room to ease again into 2025. Market is still pricing only 13, 14 basis points for the end of the year, but I think there's a greater chance than not that they will go again. I don't think they'll exceed to the downside their estimated range of neutral policy, which on the downside is 2.25%, but I think they'll get a little bit closer. And if I can just tie this into the currency right now, it's tough to look at any moves in the Canadian dollar and find a Canada-specific rationale for that move with all that was going on today. But I do think on balance, this week's decision does add a little bit near-term downside to the Canadian dollar, sort of against our expectation, but in the near term, we do feel that it is a little bit of a downside risk just when we're considering this dichotomy between the Fed meeting and the Bank of Canada, because we really actually are seeing it degrade some of the fundamentals. Yield spreads are widening a little bit. We also had copper prices plummet yesterday, which should be a headwind for the Canadian dollar, given the correlation between copper and CAD has been relatively strong the last few months. So, I really think if we're going to see a rebound in the Canadian dollar, it's probably going to take a turn in the US dollar. But the last thing I'll say is that CAD on crosses, at the least, has been resilient. Its beta to the US dollar has been holding up, and it has performed pretty well on crosses. It's gained against the G10 alongside the dollar. While it's, of course, fallen a little under 2% against the USD, it has gained against the G10. So we do think that relationship can persist.
Yeah, I think it's really interesting to think about the Fed's response to tariffs versus other central banks' response to tariffs in a broad scope, because the growth and inflation implications are different. And a number of central banks have taken relatively hawkish stances. At their most recent meetings, we saw the Bank of Japan reduced the uncertainty around their expectations, slightly higher price outlook. The ECB certainly leaned into the idea that growth might be a little bit stronger because of a resolution, or at least a reduction in uncertainty around trade. And the BOC, maybe there might have been an argument for them to kind of lean in the same direction. Instead, they kind of reopened that door a little bit more for easing. So certainly an interesting dichotomy where a number of central banks used their most recent meetings to sound a little bit more optimistic thanks to a reduction in uncertainty. I wouldn't say that BOC necessarily didn't completely do that, but really interesting to see them kind of open the door for resumption of rate cuts after what's been a bit of an extended pause here. I do want to come back to the U.S. to talk a little bit about the quarterly refunding announcement we had in the U.S. because this week has been all about I think a clearing of consensus positions. That includes short dollars. Certainly that's been under pressure. The dollar has rallied. But I think as an extension of that, I think the market consensus has been for steeper curves, steeper interest rate curves in the US, a weakness in the long end of the Treasury curve. And we've seen a flattening of the interest rate curve extend as the dollar has rebounded. And so I think the biggest driver of that has been changing expectations for growth and on the data side, on the Fed side. But I did want to ask you about the refunding and how that sort of fits into this changing of positions here. What did we hear from Treasury this week, and how is that feeding into your thinking on the interest rate curve?
It certainly didn't hurt the flattening move that we've seen over the last 2 weeks, and in fact, I think it helped. So I cover the quarterly refunding announcement a lot in our Bondcast episode, also recorded today. So I encourage our readers to go listen to that. But in brief, what Treasury announced was that they will keep coupon auction sizes stable, not only for this quarter, but for at least the next several quarters, which was consistent with their prior guidance. But nonetheless, it sets the stage for coupons to remain at current sizes at least well into 2026. What they also did was they announced that they would increase bills a little bit more in the coming days in order to rebuild their Treasury general account, which was run down under the debt ceiling. So they're going to continue to lean on bills for issuance. And the final thing they announced was that they're actually going to double the frequency of their liquidity support buybacks in the long end of the Treasury curve. So Treasury liquidity support buybacks are usually done across the curve in buckets. You could have a 2 to 5 year bucket, etc., out the curve. And they announced that they would increase or at least double the frequency of these buybacks in the 10 to 20 year bucket and the 20 to 30 year bucket. So it essentially doubles the amount that they're going to be repurchasing in the long end of the curve. And I think that, like you said, it definitely supports the flattening that we've seen over the last couple of weeks. Here we have a Treasury that's clearly biased to lean on their issuance needs in the front end, while at the same time buying back a greater amount of securities in the long end. And to be fair, we think both of those trends will continue not only through the end of this year, but also into 2026. We think that they're going to continue to increase bill sizes, and we think that they could potentially announce yet another expansion of buybacks in the long end of the curve. So, like you said, we've certainly seen a reversal, if you will, of a very popular steepening trend for most of 2025 to now a flattening over the last couple of weeks, and one that we think can continue, not only because of our more hawkish view of the Fed, which you touched on, but also because of this more active and directed Treasury, if you will. So we think there is scope for this to continue going forward.
Yeah, super interesting to see Treasury, how they approach, the stated objective of both the president and the secretary, Treasury secretary, who have both talked quite a bit about, trying to reduce long-term yields, whether that be for political reasons or for just, for journey management reasons. Trump is very big on trying to lower long-term rates to facilitate home buying and make it easier for individuals to buy homes. And, there have been a number of developments sort of outside of the traditional, say, monetary policy or economic zone, the Treasury's sort of approached, whether that be SLR reform or, in this case, changing the buybacks to maybe sort of encourage lower yields in the long term. So, I still think the bigger questions around curve shape are going to come down to things like the Fed and where we go on stimulus and ultimately the U.S. fiscal backdrop. But super interesting to hear, and I feel like you're exactly right that just feeds into what over the last few days has been a reduction in popular positions. That includes short dollars, and I think it includes steeper interest rate curves as well. So we'll see if those trends continue over the coming weeks. We have a lot of data coming up, and of course, we're all looking forward to Jackson Hole in a few weeks when Powell's going to have an opportunity to maybe reset or reconfirm expectations with a whole new data cycle in hand, including some inflation and employment data. So maybe we'll pause it there and leave it for next time. So Ian, thank you very much for joining, and to our listeners, thank you very much for listening. If you enjoyed today's podcast, please consider giving it a like and also subscribing to our channel so that you can get our latest content the moment it's released. Thank you very much.